The oil market is screaming severe and deep recession, even though stocks are telling us the worst is behind us and we're onward and upward to economic growth. One is right and one is wrong, or what could end up being the worst possible scenario, both could be wrong. What's up, guys? I'm Nobody Special, and with that, we are going to shrink my big melon of a head and take a look at what's going on in crude oil right now. Look at this chart. Absolute terrible, terrible looking chart for oil. What you're looking at here, we've got the previous bottom from September 28th that I called. Well, turns out that wasn't such a good call after all, because although we did rally off of that a little bit, we have recently broken down below that level on the news that OPEC was not going to cut production in the month of December. Something I thought they were going to do, and I had talked about that in some of my live streams. Well, it turns out OPEC left production where it was, and oil has sold off hard all week. So what is going on here? What is the oil market telling us? Well, the oil market is telling us that there is a very severe and very deep recession just over the horizon for our economy. Oil is the lifeblood of the economy. You can't have economic activity without oil consumption. And the fact that oil markets are falling off a cliff like this is the market forecasting a big drawdown in economic activity. And look no further than this article here in CNBC, dated just 2 days ago. Freight rates from China to the West Coast down 90% as global trade falls off fast. A 90% year-over-year drop in ocean freight rates for cargo from China bound to the U.S. West Coast exceeded expectation among logistics firms for just how fast trade demand would fall. And scrolling down in this article, I want to zoom in on a couple of key points here. Orders are definitely down. Volumes are way down, said Joe Monahan, CEO of Worldwide Logistics Group. Overall vessel utilization is down, even with a large number of blank sailings. A blank sailing is a canceled ship. So not only are they canceling entire trips, these ships just aren't sailing, but the ships that are sailing aren't fully loaded. Fewer ships carrying less stuff. According to Freightos, despite the increase in canceled sailings, which has cut vessel capacity, the hemorrhaging of ocean freight prices continues. So even though they're canceling ships, the prices are still dropping. And look at some of these numbers. From Asia to the U.S. West Coast, the rate is 90% lower than the same time last year. From Asia to the U.S. East Coast, they're down 78% than the same week last year. And from Asia to Northern Europe, down 73% versus the same week a year ago. So this is not just an isolated case of one port is finally catching up with the backlog or anything. This is the polar opposite of what we saw last year. Ocean freight rates have absolutely collapsed, not just to the U.S. West Coast, to both coasts and to Europe. And what this means is people are buying less crap. A few months ago, I did a video about how Target and Walmart were canceling tens of billions of dollars worth of orders, and that is finally starting to show up in what's actually being shipped across the pond. Okay, so the oil market is screaming recession. What about stocks? Well, take a look at this chart. This is the Dow Jones Industrial Average, and look at this monster rally in the Dow over the last couple of months. Let's zoom in on here. The Dow is currently up 17% off its low seen from the end of September. This has been an absolute monster rally for the Dow Jones Industrial Average, trading well above its 200-day moving average, even breaking above this declining trend of resistance that it's been in all year. This latest bear market rally for the Dow Jones has been the biggest one out of the three we've seen this year. It even broke above the previous high. Even after this lousy week that the Dow has had, the Dow Jones Industrial Average is only 9% off its all-time high. So we're closer to making a new high than a new low in the Dow. So stocks here are looking very optimistic. They're saying the worst of inflation is behind us, the Fed is going to ease up on its tightening cycle, and maybe we're going to make some new highs. And that brings me to this article in Bloomberg dated this morning. Top money managers see global stocks gaining in 2023. A Bloomberg survey shows optimism for the years ahead, but worries about stagflation. Stagflation, that's interesting. Put a pin in that. We'll come back. Some of the world's biggest investors predict that stocks will see low double-digit gains next year, which would bring relief after global equities suffered their worst loss since 2008. Amid recent optimism that inflation has peaked and that the Federal Reserve could soon start to change its tone, 71% of respondents in a Bloomberg News survey expect equities to rise versus 19% forecasting declines. For those seeing gains, the average response was a 10% return. So these two narratives right now are totally contrary to each other. We've got the oil market falling off a cliff, saying there is a deep, severe recession just around the corner, and the shipping data out of China supports that theory that says global trade has ground to a halt. Consumers, namely U.S. consumers, are in deep trouble right now. That means a slowdown in economic activity across the board. And yet at the same time, you've got the money managers saying inflation is beaten and the Fed is going to ease up. So we're seeing double-digit gains right now. So one of these things is not like the other. If the oil market is right and there is a severe, deep recession just around the corner, then these oil prices could be justified. But in that case, stocks would have to correct violently lower in order to fall in line with that. If the shipping data out of China is to be believed, then we're a few months away from a collapse in the earnings of these companies and a contraction in the multiples that those companies are trading at, which would mean stocks have to move sharply lower to fall in line with what we're seeing in oil markets. Now, the flip side, if the stock guys are right and we are looking at double-digit gains in stocks next year, well, you can't have additional economic growth and economic activity without more energy consumption. And despite the unicorns and rainbows ideals of the people who are flinging ketchup at paintings right now, you can't have more economic activity without consuming more oil. So if the stock guys are right, and the stocks are going to run 10% on all this economic growth, well, then we need to see a violent correction upward in oil prices in order to match that. So one of these two cases has to play out. Either stocks need to move sharply lower, or oil needs to move sharply higher. But remember I said there was one scenario where both could be wrong. And remember when I told you to put a pin in that stagflation issue? And for that, you got to look at this tweet from a few days ago from Javier Blas. He says U.S. total crude inventories, which means both commercial and the Strategic Petroleum Reserve, have fallen to a 36-year low, dropping below the previous bottom set in 2001. Look at how low America's inventory of oil is. Not just the SPR and the commercial inventories. Both are being drawn down at an alarming rate right now, a rate we have not seen in decades. So while the price of oil has been falling, it's been falling because America has been subsidizing low oil prices for the whole world. As Javier Blas often puts it, America has become the barrel of last resort for the globe. The drawdown of commercial inventories and the selling off of the Strategic Petroleum Reserve has suppressed these oil prices, something I've been talking about for a while on this channel. One of the reasons why I've been saying oil prices need to move higher is because of this drawdown in inventory. Oil markets have been faked lower by selling off oil that was bought decades ago. Well, that is all drawing to an end right now. The dumping of the SPR ends this month. The final barrels that the Biden administration authorized months ago are being released as we speak. So barring any further announcements of additional drawdowns in inventories, that's it. We're finally going to be left with what is the actual supply and the actual demand of oil. So in a Goldilocks disaster scenario, we could see both of these situations are wrong. We could see stocks correct violently lower on the collapse in global trade. At the same time, we could see oil prices move higher because this fake supply, America acting as the barrel of last resort for the globe, is going away. Right now, oil markets are trading as if this recession is already here and as if this artificial supply is going to continue forever. So long story short, with everything I'm seeing in markets right now, either stocks have to move sharply lower or oil prices have to move sharply higher, or worst case scenario, both could happen. Stocks could move sharply lower and oil could move sharply higher. And that would be a stagflationary nightmare for the U.S. economy. And we may get the answer to this question very soon because next week we have CPI on Tuesday. The market is expecting a lower inflation read. And then we've got the FOMC on Wednesday. The market is expecting Jerome Powell to ease up on his hawkish rhetoric. So buckle up. Next week is going to be a wild ride. I don't know which way things are going to break, but my guess is whatever happens next week is going to be a pretty big move. Until next time, live small and dream big.